I'm Chuck Osborne.
And I'm Michael Smith. Welcome to our podcast, which is presented by Assured Partners Investment Advisors,
where we talk investing and all things related in a way you can understand.
Woohoo!
Hi, this is Chuck.
This is Michael, and it's Tuesday, March 13th, 2025. It's the 18th episode of our podcast. Chuck, what is on your mind?
Rebound, Michael. We have rebounded. So
markets are popping back a little bit, aren't we?
I know. We're not just talking about the NBA playoffs.
Yeah, that's right. There's not been enough of rebounding in the NBA playoffs.
But markets are back.
Yeah. Well, this reminds me of my favorite quote, one of my favorite market quotes, which will set this up nicely, which is, I think Benjamin Graham said it, but maybe Buffett did, that, in the short term, the market is a voting machine. In the long term, it's a weighing machine. And I think that says a lot kind of with what's going on. So why don't you talk a bit?
Well, right. Well, what they mean by that quote, in the short term, it's a voting machine, and it's usually a voting machine on whatever is happening, in the world. And obviously, so far this year, everybody's been preoccupied with tariffs and a trade war and all of that. We've talked about it. We've written about it. So we're right there with everybody else. And of course, it's an interesting topic, and ultimately will have an impact on the economy. But investing is always best done from the bottom up. So it's really a matter of looking at what's happening at the individual companies. And the reality is, yes, there's been breakthroughs and negotiations, and the trade situation seems to be getting better. But companies are reporting, and earnings have been really solid. And frankly, not enough people are talking about it. I mean, I think S&P 500 earnings, with 90% of the companies having reported, are up, 13.4%? Is that right?
Yeah, 13.4. And, at the beginning of the quarter, it was expected to be, I think, near 8, if my memory serves. So up meaningfully and better than expected.
Yeah, much better than expected. And I mean, and these are anecdotal, but sometimes we like using specific examples because I think it makes it more real for people. As always, we say these aren't a recommendation to go out and buy anything, but it gives you a little education here. But you got a company like Microsoft, one of the largest companies in the world, and it grew earnings this quarter by 17.69%.
Mm-hmm.
I mean, that's Microsoft. And of course, the market reaction, the stock was up almost 9% the day that was reported. We got a more cutting edge company example would be a company like AppLovin, which is a technology company that helps people who develop apps monetize those apps so that they can actually turn those into a business. And this company, stock was up almost 12% the day it reported. EPS grew 142%.
Mm-hmm.
So, we get growth like that, then you're going to see stocks go up, because ultimately what the price of stocks is based on the earnings, and not politics or even economics. So that's what's happening in the actual market.
Yeah, and we're seeing it. It's good to see the growth earnings, the large cap growth earnings, hold up here, because one of the market's big worries, frankly, was that those earnings couldn't continue to grow at the level that they had been. And I think that was, again, these are narratives that drives these things, but you're just not seeing that play out at all. You're seeing these great large companies and the companies as a whole just really continue to grow nicely here.
Well, you're absolutely right, Michael. And I think also to put this in context, where a lot of people thought this might not be the case, is that we've got the GDP report for the first quarter, which was negative. And of course, we spoke about that in our last podcast. We were projecting a negative growth in the first quarter, but all of that was because of trade. And that does not mean that we are actually heading into a recession. And I think that's important for people to understand. So that negative 0.3% GDP growth was due to a lot of people and a lot of companies bringing forward their international demand in anticipation of tariffs raising prices. And so you had a lot of people bring that demand forward. And imports, as we've discussed in the past, are a negative in the GDP calculation. They're not a real negative in terms of actual what's happening in the real world, but you have to subtract them out from the GDP calculation, because if you don't, they end up being double counted, because anything that's imported is eventually sold, and that's counted as part of consumer consumption. And if you count it as part of consumption and you count it as an import, that would be double counted. So you have to subtract out the imports from GDP, and that's really the whole reason why we had negative GDP growth.
Yeah, it's not because of it. It's not an actual consumption issue at this point. It's not that it couldn't have been, but I mean, we are at a point now where a lot of the more egregious tariffs have been pulled back. I don't want to talk about that much, but that's also helpful from a narrative perspective. But it's a good point. In the actual economic data, you're not seeing problems yet. Inflation is looking solid. We had inflation come out today. It looks solid. And so, the real data looks plenty fine right now.
Yeah, the CPI came in at 2.3%. That's the lowest it's been in a long period of time.
Yep.
Now, also to your point, there are companies out there, and this is the thing that we talk about our clients all the time, is, unfortunately, what happens in our industry nowadays is everything is generalized to the market. Everyone is buying, the entire index, every single company, and we've kind of lost the art of bottom up stock picking and how do you actually analyze a specific company. So another example of a company that earnings was not taken well would be Fortinet, which is a technology company that cybersecurity, provides security for folks, and their stock was down almost 8% the day it reported. Now, the absolute growth number is fantastic. I mean, they grew their earnings at almost 35%, 34.88%. But that was less than expected. Mm-hmm. And sometimes, when you don't, live up to expectations, your stock price is going to get punished. They also didn't have a great guide into to the next quarter and the rest of the year. That had a lot to do with why their stock price went down as well. But I think the point that should be making is that when you're making investment decisions, make sure that you're not making them based on some big headline that the market just happens to be voting on in the very short term. But the wise investor makes investing decisions based on the actual value of the investments that they're investing in. Yeah. And that's why Benjamin Graham, who passed down to his star pupil Warren Buffett, that adage that in the long run, the market is a weighing machine, and it weighs every individual company individually.
Yeah, well, that's extremely important. And I think when you put the growth into context and you think of it against a Fortinet situation, or against when we start talking about asset classes and value versus growth and all these other things, absolute growth is important, but the more expensive you get on the valuation side of things, the more important it's not just what absolute growth is, but you have to beat expectations. Things have to be getting better because markets are looking forward and they're looking at what you're seeing going forward. So a company can be fantastic and have great absolute growth, but if you miss expectations and you're highly valued, your stock price can still go down. And that's how that works, and that's how you see in these situations sometimes.
Yeah, and that also brings up a lot of people were pessimistic going into this year because the market as a whole was extraordinarily expensive, and technology companies specifically were very expensive. Based on our work, the market as a whole was valued at 2 standard deviations above normal.
Yeah, even a hair more than that, really. So yeah.
Yeah, and technology specifically was almost 3 standard deviations
Yeah.
uh, above normal, and you know, for those who can't remember their statistics class, basically that means they're more expensive than they are 99% of the time. I mean, it is. This was a very rare event in terms of how expensive the market was, but when we say the market's expensive, that is relative to earnings. And what we're really looking at there is the price to earnings ratio, and there's two ways to lower that. The first way is for the price to come down. The second way is for earnings to go up. And so what we have is, at that point, fourth quarter earnings had not been reported yet. You report fourth quarter earnings; they're up 14% for the S&P 500. As we just said, in the first quarter earnings that have been reported thus far, with 90% of the companies in, are up 13.4%. Those two very positive quarters in a row brings that earnings number up quite a bit. And then, we have the correction that we had from from the tariffs and trade and so forth. All of a sudden, valuations have come down quite a bit, very rapidly, probably more rapidly than most people would have thought possible.
Mm-hmm. No, that's true. We went from over 2 to right at 1, which gets you in the realm of normal valuation. Now we've moved up a bit since
Yeah.
then. We still
So
haven't
that's
gotten back to the 2% to 2 standard deviation range, which means more expensive than 95% of the time. We're between 1 and 2, but it's definitely valuations have gotten better.
right. So what you're saying is, when you're saying 1 and 2, you're talking about standard deviations,
That's
right?
right. That's right. Sorry.
Yeah, yeah. And so when you're above 1% standard deviation, you are in a situation that only occurs, 34% of the time. So one standard deviation would cover 66% of the time.
That's right.
That's when you're really, if you're within that range, you're pretty much at the average valuation for the market. So we are still slightly expensive, but we have very quickly gone from very expensive down to only slightly expensive, and that's in the U.S., which has been the best place to be by far for the last 15 years. Although that's not been the case this year, has it?
No, and that's a perfect move here, because I wanted to discuss the really from an asset allocation standpoint, which is moving a little bit away from individual companies and asset classes as a whole. The real big story about what's happened is international markets, for the first time really in a long time, are the best place to be. And we can talk about those details, but I also want to put it in the context of the whole bottom up issue of what's happening with with companies there itself, because we are, in my opinion, a little bit in the moment of this is narrative driven, and the real question is, are those companies going to see the growth that the market is putting on them, that all of these potential changes in Europe and things like that are happening? So it's a very interesting place.
And which companies are you talking about, Michael?
Well, mainly European here, but it's really companies that, it's really the idea that there's going to be, there's going to be better growth because of both more investment in these international, in Europe and in Asia in some places, that will, at the end of the day, lead to, higher returns and higher performance from the underlying companies.
I think that's right, and I think this is what you're getting to. But I think you're getting to a narrative where, the trade war is a two-edged sword, isn't it?
Absolutely.
And if we start reshoring all of our manufacturing and so forth, then that's also going to provide an incentive for other countries to do the same thing, right?
No,
And
that's right. And a little background there is that the world has underperformed the U.S.'s equity markets, and there's a lot of reasons you can say, but the large U.S. companies have meaningfully outperformed in their actual results the companies as a whole of Europe and Asian companies, and that's been real, and that's driven some of that change. And there's a real potential because of this, where some of these other companies in these countries are going to have to change how they're what they're doing, and change that narrative.
right, and that you're right that the U.S. companies have outperformed over this period. So not just their stock price is what you're
Yeah,
saying, but the actual companies themselves. When you look at the fundamentals and the earnings and the growth, it has hugely outpaced everywhere in the world. And as we know, and it's been the case for years, almost half of the earnings on the S&P 500 come from overseas. So when we talk about these big U.S. companies, Microsoft, which we mentioned earlier, these are huge multinational companies, and a lot of their business comes from overseas. In a world where we have freer trade and fewer restrictions, I think most of Europe was very happy with getting a lot of their technology and services, et cetera, from the United States.
that's right.
Um, if we get into a world where we say to Germany, just as an example, we're no longer buying your cars, then they're likely to say, well, then we're no longer going to buy your technology, and that could spur investment in Germany. If that makes and you expand that through the rest of that region.
No, that's exactly right. And so that's what we've seen. That's my opinion of what we've seen in the market so far is, you know, year to date, international markets outside the U.S. have been very strong. They've been actually positive when the U.S. was down. They were positive. They currently year to date, I think you're up about 12% in the MSCI EFA, which is the international markets as a whole. They're the best place to be, and that's the narrative. Now, then the real
Right.
question is going to become longer term. Does this actual turn into earnings from those companies? And we'll see. But it's the first time you've seen this narrative change, and it's quite interesting to see.
Yeah, and now there's also another part of that is, how does currency fly into that,
That's right. That's right.
right? So part of what has happened during the tariffs and trade war is that the value of the dollar has plummeted. And so if we just put this up against the euro, coming into this year, we were very sticky with the euro being worth about $1.08. And during this trade war, it has gone from there to being worth about $1.13. And so what that means is the value of the dollar has dropped relative to the euro. Or if you're a U.S. investor investing in European companies, the value of the euro has increased relative to the dollar. So that is the wind at your back if you're a U.S. investor investing overseas. Uh, it it hurts you if you're a U.S. consumer wanting to buy things from overseas, or if you're a U.S. tourist, wanting to take your family to Europe. All of a sudden it just got that much more expensive to do so, and the and that has also played a big role in why international has outperformed so much.
No, I agree, and that puts us back to this interesting idea of how to think about that going forward,
Right.
because international stocks have done better than U.S. Currency has made that look a lot better than what the returns would have been if you were a local international investor. Yes, it's still been better, but it's been doubly better because of currency. And so the question going forward is, again, how much of this is real? And that's what we'll have to figure out is, is this a narrative play that we're seeing so far that we want to put more money wants to be outside of the U.S., or do earnings follow that? So, but so far, we've for the first time in a long time, it's been good to have outside of U.S. exposure in your equity portfolio.
Yeah, and and at least for the last month or so, it's been good to have small companies in your portfolio as well.
Well, that's right. Part of this narrative has been that really in the U.S. it's been dominated by the large growth. It's been large growth, but large cap period, because truthfully large value has done quite well relative to everything else too. It's just that growth dominated even that, but large value has done well. We've so far seen a very nice bounce back in the small cap companies. Now at this point, it's just a bounce back. What we are seeing is they sold off pretty heavy. They're coming back. That'd be another thing that it would be really nice to see. Better results from those underlying companies, and hopefully we have a chance to see that. There's a reason you could think that could happen, and that's definitely something to be watching out for, because they are due.
They are due, and I think that leads to one final point that I would make, which is a note of caution. Since the financial crisis, and if you remember what happened in March of 2009, where we'd had this huge crash all through 2008, the first quarter of 2009, and then March of 2009, the market just went straight back up, and everyone was just almost shocked at the speed at which the market recovered. And since then, every time we have had a market correction, or we've actually hit bear market territory, which we didn't come close to this time around. But when we have had those moments, whether it be COVID, whether it be 2022, et cetera, the market has bounced back very rapidly. And I think what's happened is you've got an entire generation of investors out there who just think that's normal, who just think that that's what the market does. It's going to bounce back. And so anytime the stocks go down, they're going to bounce right back. And again, that is not necessarily the case. So a lot of what we're talking about in the big picture, we're talking about international doing really well. We're talking about small caps doing very well. This is reminiscent of the aughts, or the 2000s, or whatever you want to call them, the decade between 2000 and 2010. And that decade began with the dot-com bubble bursting, the market crashing. We then had 9/11, which was, obviously a tragic geopolitical event. It is also was an enormous market event. It was something that I will certainly never forget as long as I live. The bounce back from there was not immediate. It took almost a decade for tech stocks to get back. It took almost a decade for the S&P to get back. And in 2010, there were lots of articles about it being a lost decade for stocks, because as far as the media is concerned, the only stocks that exist are the ones in the S&P 500. But during that decade, international did very well. Emerging markets did very well in that decade. Small companies did much better, especially small value did really well. There was a lot of places that did well during that decade. And there are no guarantees in the market, but it is very possible that we are heading into another period like that, and that we aren't just going to be led by the same large technology companies that have dominated for so long.
Yeah, and I think that's quite possible. And we also need to tie that back to our original thesis of what we were talking about, which
Right.
is, what actually matters here are company results. And, no one knows this for sure, right? But from a probability standpoint, for that to happen, that actually means that those companies outside of the S&P have to do better, right? At the end of the day. Now, that doesn't mean it could be in absolute terms, it could be better than the S&P companies. There's a lot of ways you can play that, but they need to do better. You can't have a situation where the S&P grows at 10 or 11% earnings and everything else grows at 1 or 2. that won't be that situation. It'll probably be something to the effect of the S&P's earnings are hurt in some way. They don't have to be hugely negative, but they get downgraded because of a lot of potential reasons. And earnings become better in international, and earnings become better than they currently are in small caps. And that's what happens. It's not like a magic. The market just, I think a lot of people think when you talk about these things, they think, oh, well, you just have to mean revert because that's what happens. But again, what matters are the underlying fundamentals.
Right.
If those underlying fundamentals change, and
Yep.
they're due to change, then you can see that kind of movement. So,
Right. No, and you're absolutely right, Michael. And it also gets back to, again, what we were talking about right at the beginning. It's a matter of paying attention from the bottom up, what is actually happening at these companies. And, these individual companies may be anecdotal, but you have to pay attention to what's actually happening there. And that's how prudent investors invest. That's how people who are actually successful in the long run invest. You kind of have to ignore what's happening in the voting mechanism, the headline, the noise, and you got to actually pay attention to what's actually the news, which is what's actually happening at these individual companies that you're investing in, and are the earnings continuing to grow? Is the valuation sound? Is it within reason? Um, all of those factors are going to factor in to what happens in the markets going forward. And the people that pay attention to that are going to be the ones who are, going to have success in the long run.
that's right. And that doesn't matter if you're a stock picker or you're an asset allocator picking funds, if there are other advisors out there watching this. It's all the same idea. The point, Warren Buffett wasn't a value investor. I don't care what anyone says, right? Warren Buffett bought things that could be considered value or growth, but he moved where opportunities were, and a lot of the best investors move where the opportunities are. And so, the person that's not going to be successful, I believe, in this coming, uh, time period is going to be people who are dogmatic to a specific style or some specific idea. You have to be open-minded enough to say, this is where the market is moving, this is where the opportunities are moving, and that could mean having to switch and change. Because, one set of the economy, or of the market, will not always dominate returns. We know that. If you know anything out there, that's what we've seen over and over and over again. And you have to be nimble, and you have to be able to make changes for when that time comes. So,
right. And you said something right there, Michael, that just and you and I have talked about this many times. But if you're consistent as an investor, and Warren Buffett has been consistent as an investor, it means you have a consistent philosophy. It means you have a consistent mindset. The market, by definition, is dynamic. The economy is dynamic. Everything changes. And if you don't change with it, you're not actually being consistent. You're just being dogmatic, as you said. And again, it's about having a consistent process which will help you identify good investment opportunities over time. And of course, you're preaching to the choir with me, but even if you are a top-down allocator, the best way to actually set up a top-down view is from the bottom up. What is actually happening? If you want to overweight international, what is actually happening in those companies internationally? And you've got to know that. It's not enough to just look at, some economic forecast or something like that.
yep.
Yeah.
Well, I think that's probably it.
I think so. For now. So the fingers crossed. We're about to get out of earnings season, so the noise will probably ramp up, and there'll be less news to look at.
Yep.
But if our listeners and our clients pay attention to the actual news, I think they'll be okay.
That's right. Reach out, let us know if there's anything you'd like to hear about. And as always, thanks a bunch. We'll talk to you soon.
Yeah. Thanks, guys.
Chuck Osborne and Michael Smith are investment advisors, representative of Assured Partners Investment Advisors, LLC, a registered investment advisor. All statements and opinions expressed in this program are based upon information considered reliable, although statements or opinions are subject to change without notice. Information expressed does not consider the specific situation or objectives of any person and is not intended as a recommendation appropriate for any person. Viewers are encouraged to seek advice from a tax or legal professional or investment advisor to determine whether any information presented may be suitable for their specific situation. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk and, unless otherwise stated, are not guaranteed.